This is video 2, continue on discussing cash and bonds, also known as fixed interest. So if you want to invest in a company, you could choose to either purchase shares or to invest in their bonds. They're both ways that a company can raise funds for their different activities. They use this mix of debt and equity as part of their capital structure. Now, if you buy shares in a company, then you're a part owner. If you're buying the bonds, then you're lending to the company. So there's two different structures, two different ways of doing this. So both can be part of the diversified portfolio that you're creating. It's important to think about what are the investment objectives. So if we compare bonds to shares, bonds are less risky. They've got a stable amount of income. They're desirable for diversification, but they also offer less returns than what you usually get with shares over a long time frame. So here's an example. Imagine we've got $20,000 to invest. So perhaps we would choose between two things, investing in shares or investing in a bond. So option A, $20,000 is invested in bonds. They're 10-year bonds and they have an annual coupon amount of 5%. And option B is $20,000 in shares with a 5% dividend yield. So is there a difference between these two? Yes. So the bond is going to pay 5% of the fixed amount that one bond is. They've got $20,000 worth of bonds, so 5% of that is $1,000. So they're going to receive $1,000 every year no matter what happens. But the dividend payment, it can vary each year. The $20,000 that's paid up front for the bond, that will be paid back at maturity date. But that $20,000 that you invest in shares, it could be less, it could be more. It just depends on what's happening with the share price in 10 years' time. So most bond investments, they're designed to give regular income and preserve your capital. So they're considered to be low risk compared to shares. Let's have a look at some more differences between shares, which is equity, and bonds. Remember, that's debt. So under shares, you own part of the company, but a bond, you're a lender to the company. If you have shares, then you're going to receive your income as dividends, and that's discretionary depending on how the performance of the company is in that current period, that current year. Whereas under bonds, we call the income coupons. They're a regular set amount. You know you're going to receive it as long as the company doesn't go bust. Capital preservation, under shares there's no guarantee you'll get your money back. Could be more, could be less, we just simply do not know. But with bonds, you know that you're going to get that amount back in full at maturity as long as the company has defaulted. It's generally riskier to have shares and less risky for bonds. If the business is having a good year, then your dividends will be higher that year. So you can benefit from that, and also the share price should increase. But if you've got a bond, you're going to be receiving the same coupon amount and you're going to receive the same principal amount back at the end. If the company's going badly, the dividend payments will probably be reduced and the share price will probably be reduced. But for a bond, the coupon amount stays exactly the same and the amount at maturity stays exactly the same. If the company declares that they're bankrupt, then as shares you're going to get nothing, you'll lose all your money. but bondholders, they've got a higher claim in the sort of the ladder that there is, so they should be able to get some of their investment back. There are still risks in investing in bonds. The interest rate changes, so the interest rate risk. So the market interest rates, they impact bond prices. So higher interest rates reduce bond prices, and the opposite happens as well. We've got purchasing power risk, so the chance that the bond yields will lag behind inflation rates. There's business and financial risk, so there is a chance that the business might go bust and they'll default on paying back the interest, coupon payments and the principal payments. There's liquidity risk, so imagine you bought a 10-year one, partway through you want to cash that in. It can be hard to sell them in the secondary market. Then there's the call risk, so that is something we haven't talked about before. That's the possibility that the bond will be called or retired before the maturity date. So that means you've ended up with this money that you weren't expecting. You thought you were going to get it in 10 years, you've received it after 7 years. What are you going to do with that cash to invest it? When we're looking at the price of bonds, it is made up of the bond coupon, the maturity date, and the movement of the market interest rates. Now, it's important to remember that a bond has a face value of $1,000. Okay, so I'm assuming that you're going to know this. One bond is worth $1,000. So we have a premium bond or a discount bond. So a premium bond has a current market price in excess of the par value, or a discount one is a bond with a current market price below its par value. So let's have a look. We've got face value of $1,000. The price is being quoted as $100. Market price $1,000. The bond's trading at par. The market price is $1,010, so that's a premium to par. So par value is like the sort of the standard set amount of $1,000. If it's $990 is the market price, that's a discount to par. Let's have a look at the behavior of bond prices. So this is time across the horizontal axis. Let's have a look at bond price behavior. So the volatility of the price, it depends on the coupon payments and how long it is to maturity. So bonds with lower coupon amounts or longer maturities are more responsive to changes in the market interest rates. So if they've got lower coupons and longer maturities, they're preferred if there is a decline in interest rates expected in the future. Bonds with higher coupons and shorter maturities are preferred if there is expected to be an increase in interest rates in the future. Now let's have a look at this picture. So across here, horizontal, we've got the number of years to maturity, and we've got the price of the bond. Now across the middle is our par value, so $1,000 bond. The market interest, the bond is 10% bond, and the market interest rate is 10%. So you can just see it's a straight line par value bond. Okay, now this bond is a 10% bond. What happens if the interest rates are now 8%? Well, if we haven't got very long to maturity, it's still going to be $1,000. But if we've got 5 years to maturity, you can see the price of the bond is going up. And the longer it is to maturity, the price is increasing even more and more, because the market interest rate is only 8%, but this bond is giving us 10%. And if we think that it's going to stay around 8%, it's worth quite a lot. Let's look in the other direction. So here we've got 12% interest rates, and this bond's only giving us 10%. Now, if it's back here at the beginning, almost not very much time left to maturity, and it's just the same price for $1,000. But if we've got 5 years left to maturity our interest rates are 12% in the market, but it's only giving us 10%. It's a discount bond. It's worth less. So I mentioned this earlier, calling in bonds. So for some reason the business decides, no, that's it, I want my bonds back, I don't want to be owing that money anymore. Then they use this call feature, so purchase back the bonds. So there are different types. It could be that the bond is freely callable, so at any time it could be retired. It could be non-callable, so they can't retire it early and have to wait for the maturity date. Or perhaps it's a deferred call, so there's a certain period of time which you can't call it, it's non-callable, and then after that period of time it could be called and retired at any time. So perhaps it was an 8-year bond, the first 3 years you can't call it, but the next 5 you can. So they would use this call feature to retire bonds when the interest rates are going down. So perhaps they've, like the example we looked at before, it was a 10% bond. The market interest rate is dropping, maybe it's dropped down to 8%, so they're going to call it in because they're paying more than what they would by getting finance from other places. Now to do this, there's usually a call premium, so an extra amount they have to pay on top of the bond's par value or face value to make up for the fact it's being retired early. And there's a call price, the face value plus the call premium. So we add those two together. So is our bond secured or unsecured? So secured debt is when it's backed up by something. So for example, you have a mortgage, you are securing your debt with that home. So if you don't pay, then they will take that asset. So it's backed by something, real estate or some kind of financial assets or equipment. Unsecured debt is just being backed up by the promise. So yes, we promise to pay you the interest and principal on a timely basis. Subordinate debentures are unsecured bonds, so their claim is secondary. Remember, if a business went bust with a normal bond, then we had a claim. Then we've got income bonds. So they require interest to be paid and a specific amount of income after a specific amount of income has been earned. So treasury bonds, we're looking at different types of treasury bonds. They're the ones we've talked about. We use that for our risk-free rate, very popular, high AAA quality. The government's backing it, so very liquid. So you can sell them on the secondary market. Their maturity is up to 10 years and they have face values of $1,000. Then we have corporate bonds. So there are different types, different industries, and they're issued by Australian companies and pay interest twice a year. Also, they have face value of $1,000. Usually issued with a single maturity date for 3 to 10 years, and they give a higher return. They're more risky and they give a higher return than the treasury bonds. There are also specialty bonds, so it could be zero coupon. They're not paying any income. They could be backed by mortgages, asset-backed junk bonds. I don't think we want those. Foreign bonds, so we could be lending money overseas, so they would give us a higher yield and better returns, but then we've got problems with our Australian dollar going up and down. So there are two main ways of investing, using US dominated bonds and foreign pay bonds.